To say we live in interesting times is certainly a euphemism. Since the beginning of the year, we have seen that many financial asset prices firstly appreciated significantly and much more than what most people expected. But the appreciation in asset prices since the beginning of the year was also associated with an enormous amount of volatility. So therefore, it made for very tough investment times, and clients certainly experience it exactly the same way. But if we stand back and we look back at what has happened over the last 6 months, I think from a top-down perspective, we've seen very little surprises. We've said right at the beginning of the year that we are in very advanced stage of the global economic cycle, and therefore one must understand that investors are quite nervous in this particular stage of the economic cycle. And if you see any particular events, the market will respond quite aggressively to those events. And that is exactly what has happened. So initially, the big change came in December last year when the Federal Reserve changed their tact and moved from being quite hawkish, in other words, quite aggressive in terms of monetary policy implementation, to be far more accommodative. The market liked that, and equity prices in the US went up by more than 20% year to date. In Europe, the prices were a bit more subdued, but still most of the European equity markets gained double-digit numbers. But for us, the one price that we struggle to explain is the very strong performance that we've seen in global government bonds. If you buy a 10-year German government bond today and you hold it for 10 years, you are guaranteed to get a negative return of 0.3% per annum over the following 10 years. So if we take that across to South Africa, South Africa shared in the upcycle of financial asset prices. Our own market is up by about 10% year to date. Our bond prices also strengthened a bit, but it is true to say that we didn't share in the full extent, firstly, and secondly, our market was also far more volatile than what you've experienced in global markets. You would recall that from a macro perspective, we have said that South Africa struggles with the low growth trap in terms of economic activity. And of course, since we've last spoken, the first quarter economic growth numbers came out and the economy shrunk by 3.2% in the quarter. So again, there's no surprises. I just think that the extent of the decline in economic activity in South Africa was a surprise to investors and to economists, and as a result of that, we have seen that despite the fact that the overall index is up by about 10% year to date, that certain sectors within our own equity market struggled immensely. And if I can summarize, those counters that really struggled were the counters that made their profits predominantly from the South African economic activity. So it was really an interesting time, lots of volatility, but unlike 2018, we can clearly see that investors, at least for the first 6 months of this year, were rewarded for the risk that they've taken by investing in so-called risky assets, which were equities and globally in the property market. The macroeconomic outlook hasn't changed much from what we said we think would happen at the beginning of the year and later on at the beginning of the second quarter. To our mind, it is still pretty clear that the global economic cycle is in a very advanced stage and that economic activity is starting to roll over. Now, maybe it is just important that we define rolling over. We are certainly not arguing that the global economy will drop into recession. The US economy is simply slowing, employment levels are still very high, and what we see is that monetary authorities are starting to respond to the activity starting to roll over. So if we have to put a number in terms of economic growth forecast, we reckon that the global economy can grow at about 3.5%, with the US economy the stronger economy, Japanese economy flat, and I think in all likelihood the European economy will probably surprise in the second half of this year, as many of the macroeconomic indicators that have been released recently would indicate that there's renewed activity in that particular region. Of course, importantly for South Africans is what is going to happen in China, and it's quite clear that exactly the same trend is starting to emerge there. growth activity is slowing, and where we have seen a growth rate of between 6.5% and 7% in 2018 for the Chinese region, we reckon that for the full year 2019, activity should slow to about 6%, which is still a significant achievement, but you can see that the trend is lower, and therefore one would expect softness in the demand for commodity prices. With that in mind, you must understand that, again, as we said earlier, that investors are likely to be quite nervous in their response to what they regard as risky developments. And again, the so-called tail risks that we mentioned in our previous session, those same tail risks are still very dominant in shaping investor sentiment in the short term. And maybe we should just highlight them. The first thing that comes to mind, of course, is the trade tension between the US, and now not only between the US and China, but also US and other important trading partners of the US. That is the first thing. Secondly, Brexit just doesn't want to go away, and I think that will certainly come to the fore in the third quarter of this year. And thirdly, and that for me is perhaps the most important one because it's a fundamental issue, and that is how central banks are going to respond to the slowing economic activity. It is quite clear that investors expect the Federal Reserve in particular to be very dovish or very accommodative when they formulate economic policy and interest rate policy in particular. And that for me is perhaps the big risk. If the Fed is less accommodative, that the market might not like that, and that might put pressure on risky assets, and of course in particularly with global equities. So those are the three things that I would like to leave you with. To summarize, in the late stage of the economic cycle, there's no doubt that these tail risks, but particularly politicians and economic policymakers, will steal the limelight and will influence investor sentiment in the short term, and that might lead to higher volatility. If we can turn to South Africa, nothing has really changed. I think the only thing is that economists are now starting to downscale the economic forecast for this year, and we have recently seen that the Reserve Bank have downscaled the economic forecast for a growth rate of 0.6% for 2019. Now, we have always been very clear that we are in a low growth environment, and therefore that is certainly no surprise for us. If you look at the investment landscape and where we can make money for our clients, in a recent newsletter, I've stated quite clearly, if you look at the investment menu, there's not a particular dish that looks particularly attractive. And the reason for that for us is quite simple. The most important price, namely interest rates and global interest rates in particular, is very low, and that distorts the valuation of most asset classes. So when people argue about the attractiveness of the different asset classes, the starting point is a very awkward one with interest rates as low. And I want to specifically focus on global equities firstly. If you look at global equities, over the last 5 years or so, we got an average return of global equities in dollar terms of just about double-digit numbers. From the starting point now, we believe that investors should downscale their expectations to about 6-7% over the next 3 years, and it's simply a valuation measure. But when you look at the relative attractiveness of an equity portfolio versus a bond portfolio where those bond yields are at extremely low levels, global equities still remain more attractive on a longer term basis, despite the risks that they represent at a very late stage in the economic cycle. Global property is probably fairly priced, so when we populate global portfolios for clients, we still favor equities to global bonds, and we still favor equities to property, which is fairly valued. But we want to warn that investors must downscale their expectations in terms of global returns when we look at that landscape. If I again look closer to the South African environment, it's a bit different to the international environment. Firstly, if you look at the bond market, bond yields are still relatively attractive to inflation. Inflation is sitting at about 4.5%. The bond yields, 10-year bond yields are trading around about 8%. So you get a real yield of 3.5% that on the face of it looks quite attractive. But we've got to be very clear that the biggest concern for us when we look at the local economic landscape is the fiscal problems that we sit with in South Africa, and particularly the fiscal problems that originate from state-owned entities that are in desperate financial trouble. Despite the fact that those yields look attractive, we prefer not to be overweight and run after the yield, because the narrative to our mind is very negative as far as the asset class is concerned. When you look at the South African equity market from a price earnings perspective, the market looks reasonably priced and the market is quite rational. When you look at the performance generated by our market, there's been a massive disparity between the top performing shares and the poor performing shares. Just to give an example, Anglo American Platinum gained 150% over the last 12 months. Aspen lost more than 60% over the last 12 months. So there's more than a 200 percentage points gap between Aspen and Anglo American Platinum. And that was the theme over the last 12 months. And we believe now, given that disparity, now's the time to look for shares that are exposed to the South African economy that reflects value. So the entire effort that we put in terms of our local equity team is to look for opportunities within the local economy where we can identify value, but where we are also quite comfortable that the operational conditions for those companies are sound enough to take us through this cycle of poor economic growth. So in future, we still believe that South African equities offer an attractive investment proposition for clients over a 5-year period, but when we populated our local equity portfolio, where the focus was clearly on rand hedges, we will gradually and in a very measured way start to change the makeup of the portfolio and introduce more shares that give us exposure to the local economy. And of course, finally, that leaves us with property. Now again, if you look at property yields, they look very attractive. You can buy many listed property companies that yield more than 8%, which again gives us a very good real return if nothing happens in the property market. However, over the last economic cycle, what we have seen is we've seen a massive oversupply of property across all 3 major property categories: office, retail and industrial. So we would be quite cautious to simply buy into the yield story, because we believe that this oversupply of property needs to be worked out of the system, and that will take time. So again, as I said, if you look at the entire menu, bond yields attractive, but the story negative. Property, exactly the same. And that leaves us with equities that gives us the best prospective returns over the longer term, but one must always remember that all the news that at the moment dictate investor sentiment is likely to have a massive impact on investors' response, and therefore volatility will still be part of the investment landscape going forward. So to summarize, the investment environment will remain quite uncertain, and it's quite understandable that investors would like a neutral positioning in their investment portfolios. And we would agree with that. However, volatility, although it is very uncomfortable for the final investor, is the investment manager's friend. And we will use the investment volatility or the volatility in investment markets as a tool to increase exposure to assets that offer decent prospective returns over the next investment cycle.